The importance of data in the economy has been captured by Professor Klaus Schwab, Executive Chairman of the World Economic Forum. His analysis entails that the world is entering a fourth industrial revolution, powered by artificial intelligence and being distinguished in its characteristic of hyper-scalability, which we will discuss more in Module 6. Importantly, the fourth industrial revolution has been built on top of a third era, which started in the 1970s thanks to computer and automation. As we have seen throughout this course, technological progress and financial market development have a close relationship. Professor Schwab's third era of computer and automation coincides with the digitization of financial services, which we discuss in Module 3. And in this lecture, we are instead projecting ourselves forward, aiming to answer the following questions. How can the data created since the 1970s be used meaningfully in financial services? And what does the fourth industrial revolution look like for financial markets? The importance lies in the fact that as with any large economic shift, the relationship of money and power is being redistributed. As such, answering if financial institutions need to become data companies matters. Should their business model move towards a data refining instead of interest or fee-based income? In order to find answers, we will present 3 examples exploring in turns big data, artificial intelligence, and analytics tools. Let's start with the hedge fund industry. They have historically been distinguishing themselves by their capacity of using quantitative skills and hiring a lot of math scientists. They have increasingly been leveraging on external and new alternative data to make better investment decisions. For example, the use of geolocalization data was used to estimate the footfall in shopping malls and therefore predict the growth of sales ahead of public quarterly reports, allowing to make an investment decision before public information is out. In the context of the insurance industry, we have seen usage-based insurance changing the current flat fee insurance model and instead moving towards a pay-as-you-go service centered around your lifestyle. This has been made possible by the increase of telematics solutions such as trackers in your car or your mobile phone, which is then analyzed for better pricing. Here, data is being used to change the underwriting decision model whilst becoming the most cost-effective option for you as a customer. Finally, in banking, by using predictive analytics, a bank is able to monitor the spending patterns of a consumer and then infer if a larger purchase will be made. The size of that purchase will then define whether the bank should proactively propose a consumer loan or a mortgage. Likewise, a very simple example is taking a travel insurance as soon as you buy a plane ticket with your credit card. Now, these examples illustrate that data has previously been used in financial services, but this has not been equally done by all. This is mainly due to the fact that data today remains a byproduct of activity as opposed to a core asset that is valued. To make this change across the industry, new C-level roles are emerging, such as Chief Data Officer. Regulators are also concerned by this, and you saw that in Module 4 when we were covering the topic of smart regulation and what it means from a human capital perspective for the regulators. Now, in order to enhance the value of data, whether internal or external, going forward, financial institutions will need to consider the 3 V's of data. First, volume. The combination of behavior tracking and Internet of Things is increasing the amount of data points available. Second, velocity. The speed at which data is created requires the need for real-time analytics as it challenges the current storage capacity. Third, variety. The ability to handle, understand structured and unstructured data from internal or external sources. As this transformation process occurs, FinTech startups are increasingly providing the necessary analytical tools to process and analyze data held by financial institutions. For now, these remain narrow use cases and include identification of credit risk in loan portfolio, transaction of quarterly reports into investment advice, or performing complete audit risk review. Whilst these have always been performed by banks, Today, the combination of data availability and analytical tools make it possible to do these in seconds instead of hours. And this is done without a trade-off on accuracy levels. Hopefully, this will provide banks a capacity to restore profitability levels, whilst for consumer, create a new era of invisible finance. Ones that support your lifestyle instead of creating friction as you're trying to achieve your goals.